Hi everyone, Paul Duncan here. It's Sunday, the 13th of March. I thought I'd roll through a number of things that I'm seeing just as a weekly update. I haven't done this in about a month, so I thought this might be of interest to folks. I think one of the key things that I'm watching is my metric called the long cash ratio. And if you recall, each of the individual stocks has got a recommendation. In fact, you can see, for instance, on the control panel in the stock file that's contained in the Dropbox files, you can see that every stock has a recommendation. So if it's red, that's some form of cash, and if it's green, it's some form of long. And what that effectively means is that if it's in red or in a cash status, it's typically in a void. It's underperforming its historical numbers in terms of performance and volume. And if it's in green, it's historically outperforming its past, and that's determined by all of these numbers that you see here and some calculations that go on in the background that are transparent to you. I think what's really important here is that we have 72% of the stocks in the database are showing some form of green or long, and that's a really, really high number. In fact, if we go back and take a look at things, that corresponds to a pretty high ratio, the ratio of longs to the number of cash stocks. And let me blow this up so you can see it a little better. And right now you can see that we've been climbing steadily since the middle of January, which is when I wrote about having single-digit long cash ratios, and now you can see that we're way, way above that. In a historical sense, we don't tend to stay up here at this high range too long. When we take a look at, let's see if I've got a way to view that right now. Let's see. This is a fairly good one. This is also contained in the stock file. You can see that when we get up into the levels that are up here in the pink zone, but even more importantly, you can go back to late 2008, which is when I started using this indicator. When we start getting up into this 0.7 to 0.8 range over in here, you can look back and you can see, I mean, with some exceptions, we don't stay up here too long. We always tend to pull on down. Now, of course, there can be these W's or M's, however you want to look at it. But at the end of the day, when we start moving into this range where we are right now, caution certainly is advised. Contrast this with late January when we were in the single digits and percentages, and you can see that those typically have been really, really good buying opportunities. So that's why you see on some of my charts, you see things that are green and you see things that are pink. And so buying up in this zone is typically a challenge. Buying in this zone is usually a pretty good thing. Now you have access to this chart. I actually keep a track of this chart in the stock file. So if you download the stock file from the shared Dropbox, it says stocks on it, and you go over to the metrics tab. Here's the same chart. It doesn't go back exactly as far as that. I mean, the data's there. I just don't display it on the chart. You can actually scroll all the way to the top of this list if you want to include that. You can modify that yourself after you download the file. But you can see we're up here. And there are periods where we've gone higher, but again, we don't typically stay up in this zone for too long. Again, there are exceptions. I'm not trying to say that the past will absolutely keep us in out of trouble here, or that the past will exactly indicate what's going to happen. But I think the key here to realize is that we're in the pink zone. We're pretty high compared to historical numbers, and we really want to be very, very careful on this. If you're wondering what these numbers on the right-hand side are, This is the top of the upper range for where I like to buy, and this is the bottom of the upper range here, where once we cross this threshold, I absolutely do not buy stocks. I just it hasn't worked out well for me over this period of time. And then the solid red is one standard deviation of all of the times that we've turned up in here. And when we get above 63.3% right now, there is a greater than 60-some% chance that we're going to move here in a relatively short time back down to the downside. The bottom number, this green bar that you see right here, tells us that when we can buy below a 34% long cash ratio in the overall system, or the percent stocks that are rated that number, it usually works out very, very well. And we typically go higher at least 67% of the time, if not higher, if not more than that. And you can look back. I mean, certainly there have been some violations of these rules. There always are going to be violations of rules, but at the end of the day, buying when we drop down into these areas typically has been a fairly good thing. So enough of that. Let's go take a look at what the long cash ratio is actually telling us right now. And the LCR is, I plot the slopes of each of the moving averages on the long cash ratio. So as stocks move into a long status, or as stocks move into a cash status, we develop this ratio, and then I apply moving averages, 2-day, 3-day, 5-day, all the way on out. And you develop a ribbon of moving averages. And when you look at that ribbon, you get a sense of what the market is doing, and you know how it performs with what I call the GGT price, or the GGT index. It's just all the 3,000 plus stocks in the database with an equal weight lumped together. And so you get a kind of a sense of when things are moving up, you get a good move upward, and when things start rolling over, you get start getting a move over. And you can see actually that the peaks of the move overs start to precede the dips of the prices, and I like that. It suggests that slowing of the slopes, which is what I'm looking at, is the real indicator of when we start calling a market top or a market bottom, or whatever the case might be. So you can see a lot of green over here, and the green here means that all the slopes are pointing up. So if we were to throw a ball upwards, it's going up, and that's indicative of the green. The red over here is the slope of the slope, or this side of the chart is the slope of the slope. And so the way to think about that is, if I throw a ball upward, yes, it's going up, but over on this side it's going up slower and slower, second over second, and that's what the red here means. So this is the acceleration upward. And you can see that we hit a patch last week where we are actually decelerating, and hence why I posted on the blog, that I'm thinking that we're getting close to a market top. I'm going to show some other evidence of that too. Now, this is a local top. This is not that the bull is dead or anything like that. These give me the luxury of taking a look at many different time frames, and you can see that on the longest time frame we're still doing very, very well. You can see the magnitude of these numbers aren't really changing much. So on the longest time frames we're not really slowing down, but on the shorter time frames, if you look at the magnitude of these numbers, we really are starting to slow down. Now, Friday was a big day. Friday we obviously had a number of things move up. The LCR moved up another 13% over the preceding day. These are big changes. These are really, really important changes, and I think what it's pointing to, though, is that we're starting to get to areas that are going to be really, really extended. To go from 2.36 to 2.667 is a challenge. Now you can see last week Monday, Tuesday, Wednesday, Thursday, Friday, you can see that 2.3, 2.3, 2.3, 2.3, and then we jumped on Friday. Does that mean we're going to go down on Monday? Absolutely not. We can continue to go up. I showed you precedents for that in the past, but the key here is we're starting to slow down. And you have to admit, this is a really long run, all the way back from the beginning of February. This is a long run to be moving up day over day over day. But I'm glad we are. I'm in the market, and I advised others to take a look at things. And after a number of failed attempts, as you see right here, sure enough, with the transitions that we started seeing beginning in actually late January, but then really starting to take hold in early February, and then moving out into a medium-term time frame and now a long-term time frame, it's really recommending that we have a cash status level of 0, which means we should ultimately consider getting fully invested. Now, all the caveats of what I just talked about all apply. Do we want to become fully invested when we know that we are in overbought territory? I would caution the answer is no. We don't want to start jumping into the market with both feet. But on pullbacks, that would be a good time to start adding to positions. The thing that allowed me to post the blog the other day and say that I think we're getting a market top was a chart. Now this one's obviously updated a few days since then, but what it shows is that this is the 8-day moving average on that LCR, that long cash ratio index that I have, or indicator that I have. And you can see we peaked and then we pulled back, and then only on Friday we came back up here. And so we could have a fit like we saw back here, where we peak and we come down and we actually get below this level here, this 0 level, which would be fine. I would be very happy with that. That would give us an opportunity to really start buying some stocks. Now this is just one of those indicators, right? That's on that chart. If I go back here and take a look, that's just the indicators that have to, oops, let me go back down here. That's just the indicator that has to deal with just this area here. And it's positive, but you can see that it was up here at 0.22, 0.21, 16, 14, 10. Now it jumped on Friday to 15, and that is indeed what what you are looking at there. Right, so we had peaked up and then we'd come back down. So when you look at that, this is just one snapshot or one slice of that LCR table. So this is the visualization of that LCR table that I just showed you. Anytime it's positive, we're still moving up. So the slopes are moving positive. We're still moving up. Stocks are still moving over into the long side. They're just doing it on a slower and slower basis, and so I think that is something that we have to be aware of. All right. So what does all this mean? Well, it means, I think, for the most part, we've broken this downward kind of apparent downward slope that you have here. We're well up into this area. We've got the GGT index getting ready to hit 143-day moving average, which I think is a remarkable average. Actually, it has become support. It's one of the Fibonacci numbers if you're into those things. And you can see that GGT has respected it a lot of times, and when it doesn't, it lets us know. The key here, though, is that we're getting ready to come up to it, and whether it's going to be a resistance level for us or not will be something to be seen here. We've moved a very, very long distance in a very, very short amount of time. I mean, to go from single digits all the way up to where we are, nearly 70% stocks with long ratings out of a database of over 300 or 3,000 is a remarkable move. And then, as I said, we've got this ribbon here, and you can see the tops of the ribbons. All of a sudden, we've blown through that on many of these moving averages, and so that's something to look at. I don't normally talk about this. It's kind of an advanced topic, and I know a lot of people are just trying to get their heads around some of the basic stuff here. But the key of this, cash and buy strength, I have internal indicators which tell me on volume buying and volume selling what's going on. And anytime it's above the line here, we have volume buying, and anytime it's below the line, we have volume selling. And you can see that, when the markets are being sold off pretty hard, the price comes down, and you get these drops here. One of the things that we're seeing is a lot of volume buying. That's great, and we're continuing to see quite a bit of. We're really extended. If you look back over time here, we don't stay up here a huge long length of time. Now there is precedence to stay up. You can see this area here. And we chop back and forth, et cetera, et cetera, et cetera. So we could be on the very beginnings of some of these, extended buying sprees, which is very, very possible. Your crystal ball is as good as mine. But I think, you just take a look at recent history versus where we were several years ago when QE was really in full force, and you can see things are a bit extended right now. So I'm a little bit concerned about that. Last couple days we've had the long-term timer. This is one of the components of the long-term timer. It's been confirmed by a couple different other methods that I have internally. The bottom line is anytime we're above the 65-day EMA slope goes positive, we've turned up on a long-term basis. And if you think about it, that's 13 weeks, so it's a quarter-over-quarter basis, and that's pretty exciting. I like that. So we're definitely going back to the the timer here. We're being indicated from a money management point of view to go into the market in full, and I think that's that's a key thing here. So the next obvious question, having established kind of the snapshot of where we're at, where do we start looking for different stocks? Well, again, in the Dropbox folder that I post and keep updated with everything. You should be able to see. Let's see if I got it. I don't have it right there. We'll just go over here, and we'll go over to public Dropbox, and I'll update these with some other files that I have today. So every day I post new files in the Dropbox, and we have lots and lots of folks that are looking at these things. And so you will be able to open up the stock file. When you open up that stock file, you get this file. And if you navigate over to the dashboard tab, the way I've got it organized is that the top part of this are dividend stocks that I'm watching. And I'll update this to indicate this is actually through March 11th. And then I have non-dividend stocks, again, through March 11th. I just haven't updated the date on that. And then the parking lot are stocks that I'm watching or that I've have been on the upper lists but have begun to fail in one criteria or another. I typically only buy stocks that are green rated, which means they're long. A way you can do that is very simple. You see the 1, 2, 3 up here. There's a little block right underneath that. Just click that once, and everything here turns color. Then go over to data, and then hit filter. And you can see all these little pull downs up here. And all I'm going to do is I'm just going to turn off the cache indicators and the ones that say pending updates, because they are waiting for another computer to update some files that this thing uses. And what you're left with is all the dividend stocks that are long rated. You're left with all of the non-dividend stocks that are long rated. And then I would ignore the parking lot. I just have it in there for continuity for myself when I look at things here. And you can see there's lots and lots of stocks that are doing well. Now this CalMAR ratio, the higher the number, the more in tune my system is with picking winners. So the higher the number, the better. The lower the number, I would typically, if you're going to follow the exact timing sequence of longs and caches, then I would avoid this particular stock using this number. But there are other ways to use the system. It's a very, very flexible system. But you can see a lot of these numbers are up in the 3s and the 4s, and there's some 5s, and here's a 9, and that just means that you would have saved yourself a lot of grief following the signals rather than a buy and hold. So the key here is to to pick stocks that have a good solid rating in terms of greenness, and then another, the CalMAR ratio, which is risk to reward, or I should say reward to risk ratio. So for every dollar invested, you could have done much, much better compared to just a buy and hold, and that's what this where this comes from. So here's what the current dividend is, and here's what the dividend yield is, which can be useful for a lot of folks who are looking at different portfolios. I would caution, the higher the dividend yield, typically there's some risk there, and you can see I don't have, over in these columns, I don't have some numbers filled in here. And there's probably a reason why. It's a new company. The trailing 12 months EPS growth since 2014 is good, but the rolling dividend is okay, but major payout, then a reduction. I can't calculate the trends. I consider it risky, and so I haven't put in the numbers here. So this TTM EPS trend, this is the trailing 12 months EPS growth, and these are the number of consecutive quarters that we've seen a positive gain in the trailing 12-month report. So think of 4 quarters, trailing 12 months, sliding every quarter, and how many quarters has that number been going up? And so you can see it dropped in the latest quarter, it's been going down here in the last 4 quarters. Here it's been going up. The trailing 12 months have been, for EPS, have been going up 4 consecutive quarters. So 4 times 12 months have been rolling into a positive of growth. And you can see that the trailing 12 months growth right now, the change in quarter over quarter of one 12-month block to another 12-month block is 60% EPS growth. As many of you know, I tend to favor EPS growth and revenue growth. I think those are the 2 engines that fuel share price going up and demand and all that. And so anything that you see here that's in green will be above 12.5%, which is roughly a 5.5-year doubling of the stock if you look at the rule of 72s. And the key here is that I tend to favor stocks that have fairly high trailing 12 month EPS growth. Now this isn't the EPS, this is the growth compared to the previous quarter's trailing 12 months. So it's a different way of thinking about how do we get on board a growing company. PTP is exactly that. It's the pre-tax profits. And again, I'm not looking so much at what is the pre-tax profit value. It's going to be related to the somewhere in the percentages between the bounded by the sales growth as well as the EPS growth. It has to be, obviously, because it's pre-tax profits. And you can see the number of consecutive quarters where we've actually had gains there, too. And so if you see a deceleration occurring in some of these in terms of pre-tax profits, you know that things are changing for the company and something to look at. Trailing 12-month sales trend is exactly as it sounds. Here we have for ABBV, which is a drug company. They've been growing sales for 8 consecutive quarters on a trailing 12-month basis. It's a very good number. And you can see that the sales growth itself is at 14.5% on a trailing 12 months growth. And so visually, it's I like to pick stocks again that are in the colored green here. That's 12.5% or greater growth. Now, if you see a negative, I would run away in the characteristic lost in space, warning Will Robinson from the robot. You're going to lose money if you get into stocks that have a decelerating negative trailing 12-month sales growth. It's not a sustainable positive model. And then finally, the up-down ratio that you see here, I calculate using Better Investing's methodology, and I'll show you that here in a second, up-down ratios for what's the potential for the stock to go up versus the risk of going down. And so when we take a look at a stock that's like AOS, or actually let's just take Apple because Apple's a good example. So Apple right now has got a 21.3. I've got some comments in here, and we can go take a look at the charts for Apple. So let's go ahead and do that. I'm going to click here. When you do that, you open up something in big charts. It's just those were just hot links to pre-formatted charts that you can access. And I think the key here to understand is, so you've got Apple. That's what we got into. You can see that on a trailing EPS basis, we've got this staircase pattern, and that is something you always want to see. And you can see boom, 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 but you can see that big magnitude change, smaller magnitude change. So the EPS is slowing on a quarter-over-quarter basis, but it's still positive. You can see that we're still moving up. So the PE is dropping with this, and this is a nice chart. Rolling dividends is exactly that. I'm looking for stocks that have a increasing dividend on a year-over-year basis. So this is the rolling 12 months, and you can see that it's improving on a year-over-year basis. So that's a good thing to see, and I strongly encourage taking a look at that. If we take a look at the other link that's right here. See if I can get it to open up here. Of course not. All right, let's do this the hard way. Let me open up a browser. And I'm going to pull that over here. So this is going to go to something that I created on the 4th about Apple. This is as of the 4th. And you can see, looking on a year-over-year basis, Apple's trends are still very, very positive. I tend to be somewhat conservative in the trend line that I have here. This is looking out over the next 5 years. So we're looking at, right now we're paying a trailing 12-month dividend of 9.22, and in 5 years, that if they continue on this same path, they should be up around $22 per share. I'm projecting future sales growth on average 18.5. That may slow. We'll see. You can see that we actually had a miss in this last quarter, and if this continues, I'll move these numbers downward somewhat. Same thing with earnings. We had a little bit of a miss. I like to see this next reporting bubble above, and next reporting bubble above, and you can see in the last quarter what those numbers actually were. So instead of 12, we're at 1.7 and 7.1. On a quarter-over-quarter basis compared to 1 year ago. The key here, though, is that remember, a lot of these stocks are seasonal, and so you don't necessarily have to get wrapped up in the quarter-over-quarter performance. One of the key things that I look at here is I take a look at what the EPS is being paid out at and what the calculated high and low PEs are over the various years. I look for outliers, and I reject those outliers. And right now, Apple's PE is somewhere around 11, somewhere in that zone. And so you take a look at that value, the current PE value, and compare it to the range that it's in. It's fairly valued. In fact, it's closer to the lower side. So the projected relative value relative to PE is it's actually somewhat undervalued. And I think that is something that is worthy of looking forward here. On a trailing 12 months EPS, the next quarter is going to be right around 9.42. As we're running right now, not for the year, of course, but now this is the next reporting quarter that we're moving into. So we're actually seeing gains already. I expect we're going to continue to see EPS gains for Apple, and would move forward in that context. And then looking at the forward 12 months, we're already going to be up at 11.18 if everything remains on track. So doing all this and crunching all these numbers, we're in the buy range for this thing. You can see it's actually a pretty wide buy range from $82 up to $172. And that's where we get that 12.3 that you saw on the overall sheet. The projected average annual total return is around 24% right now, and that incorporates the 2% yield that you're getting on the dividend on the existing price. And remember, this is as of last week, and this has given us a CAGR of 29.2. So that's all really good. These are just estimates, relative values below 100%, so it's worthy of consideration. And then sure enough, you take a look at some of the growths here. And we had one quarter, these are quarter over quarter, we had one quarter of trailing 12 months where we've actually decelerated. I'm looking to see that this pulls up, but remember, this is kind of like the slope discussion that we had earlier. These are still positive numbers. So even though the trend is down, it's just saying it's not growing as strong of a trend, but it's still growing at a pretty good clip here. In fact, what is that clip? Well, you can see it on the chart above, which is this per day report. 26.9 on the EPS 12 months change, 20% on pre-tax profits, which is still a healthy pre-tax profit margin, and then 17%, down from 27% on sales, but still a 17% quarter-over-quarter trailing 12-month growth is respectable by any mark. So even though these have dropped down, I would still say this is a really, really good candidate for my money. And then there's some other tables here that you can use to plow around here. So this is all a long way of saying that there's a lot of data available to you. And so what stocks to buy? Well, again, we want green stocks. So anything that is long, affirmed long or new long. The new long means that they're just starting to transition. And they should be worthy of further consideration. I would even consider just saying greater than 2, which is the up-down ratio, and you can see that brings a number of the stocks into it narrows it down even more. So here we've got stocks that have are in the buy zone for a given set of PEs and estimates that I've done. I've done a lot of work here for you, so you don't need to worry about that. You can go click on stuff. Some of these are relatively new, and I haven't gotten around to being able to fill in the links. And if there's something here that you see that you want to get into, let me know. And additionally, I haven't been able to fill in all the prices. The stuff in blue is manually entered in. The stuff in black I actually get from a service. So it is what it is. So it just takes a while to pull in some of these these values and get all this stuff calculated. So the dashboard's one way to look at this. I'm focused on dividend stocks. The watch list tab actually has what I would consider very, very good stocks that you should be really seriously looking at. Again, I'm going to turn off the ones that are not rated into longs, and so we're left with just green here. So these stocks up here in the very, very top are stocks that have been paying out steady to increasing dividends for 25 years. So here is these are called dividend champion stocks, and you can see that right now they're all being recommended at a some form of long. The ones that are remaining here. Some of these have got CalMARs over 3.0. Typically a 3-to-1 risk to reward ratio is what you want, and the fact that we have those, I mean, all of these stocks, if you're in a dividend paying or a portfolio that is looking to have consistently gaining dividends, these would all be worthy of your consideration. The dividend contenders are 10 to 24 years of constant or rising dividends, and you can see we have more of those, of course, as you would expect. And a lot of these are again paying fairly sizable dividend yields. I haven't filled in a lot of the data on some of these. I'm getting to it. It just takes time, as you can imagine. And then dividend challengers are 5 to 9 years. So all of these stocks have been paying out a constant to increasing dividend over the last 5 to 9 years. And again, I'm slowly getting the numbers in there. It just takes time to do all this. A couple portfolios that I've got at C2, Collective 2, that I'm running. One is an accelerating sales, EPS, and pre-tax profits, and you can see a lot of green in this area. And so I've picked stocks that may be on probation. They had 1 quarter of dropping off, and so Apple, you can see, is one of those stocks. You won't see any number here lower than -1. It means that we've had 1 quarter of deceleration in whatever the column is. But you can see on a growth perspective, a lot of these stocks are doing very, very well. And again, you can just link into them over here. I've got the hot links there, and if you're interested in these, My thesis with this portfolio is that it's accelerating earnings and revenues that drive stock growth, and so this should be a over time. I just started the portfolio. Over time should be doing pretty well. Blue Collar Investor, it's actually a service I subscribe to. I'm looking at doing covered calls and cash secured puts, and I follow some of the methodology that is here, and these are stocks that they have recommended for the upcoming week, and I've additionally filtered them using my Greenfield strategy, and I'll show you that here in a little bit. And then Greenfield Leaders here is another listing that I have. All of these stocks are outstanding stocks, and as you'll see here shortly, we're actually starting to see a little bit of topping mechanism. These are very, very strong stocks. They've been doing very, very well. They were first out of the gun. In fact, let's just go over there. Let me just show you what I'm talking about here. So to do this, I use HGSI. HGSI is a phenomenally good program. If you are not a subscriber of HGSI, I urge you to seriously consider it. HGSI has the ability, you can take these lists, you can put them in, and when I grab, say, the Leaders Index, for instance, we're able to plot this. So this is an index of the leaders, the Greenfield leaders that I just showed you. And there's a lot of information here. This isn't a presentation about Greenfield or about HGSI, but suffice to say a couple things. This is the moving average convergence divergence on those stocks, and you can see that we're just starting to roll over. And this is why I called earlier this week that I think we're nearing a local top on a short-term basis. This is one of my indicators. This is based on some work that Dr. Alexander Elder did, and he uses a 13 and a 34-day moving average in conjunction with some other things. You can see we've already had the faster moving 13-day, which is in red, cross over the slower moving 34. So actually several days ago, we're starting to show a loss of momentum on for this basket of stocks that we have here. And probably more telling here, so here's the collective price action of that basket of stocks, and here's a really, really nice, this is Dave Stetler has this bow tie concept where you have the moving averages start to cross from lower to upper, and then you start expanding. This is a beautiful pattern that you have here. You can see that stocks took off, and then we had a little bit of consolidation, and then they took off, and they've been riding up the faster 13-day almost conclusively all the way straight on up, and we're just starting now to touch the 13-day. What's important here, though, is the top. Look at the tops of these over the last 2 weeks. It's almost like we have a resistance that's starting to develop here, and I think we do have a resistance. I think from the perspective of local tops, I think we're clearly looking at stocks that have gone a long way in a very short amount of time, and as a result, we need to be very, very cautious about jumping into the market, at least with this basket of stocks. So let's take a look at some other other baskets of stocks. So if we're looking at we've got the leaders here, which are telling us things should be slowing down. We've got the blue collar investor stocks. Well, let's go take a look at those. And so I've prepared that for you, just so you get an idea there. Again, you've got that bow tie concept, and we're walking up. These have been very, very aggressive stocks, and you take a look at, we've gone from roughly, where the moving average crossed here and is around 950, 960. On a relative basis, you can see we're already up here, almost 8% movement in a very, very short period of time. So the BCI, the blue collar investor stocks, are all doing very well, at least the ones that I filtered for my GGT index. And sure enough, you can see that they all broke out of that 13-day, 34-day elder thing. We haven't crossed over here, so it's still got some momentum here, and we haven't crossed over on the MACD, but you can see we're getting closer and closer. We're actually decelerating on a day-over-day basis, so the gains of this portfolio are less and less as we go forward. So if we take a look at some of the most conservative stocks, which I would consider your dividend paying long only stocks. Again, these are the stocks that are here on the dashboard, and these are the green dividend paying only stocks here. So as an index, if we were to create an index of just those stocks, what do they look like? What's the group telling us in general? Well, what it's telling us is that we've still got a lot of room that we're moving upward, right? We're starting to slow down a little bit, but in terms of the overall group of conservative dividend stocks, they're doing very, very well, and they're moving up. This is why I think we're in for a short-term pullback, but not a long-term pullback. We're not seeing a breakdown in conservative stocks and relative performance as we go forward, and I think that's very, very important. And you can also see when we look at the 200-day here, the dividend stocks just cleared the 200-day, and now we're moving up and we're coming down and we're touching the 13-day or getting close to it, and et cetera, et cetera. So the key here, and by the way, let's take a look here also at the Elder 1334-day for this, and you can see that we're still got some spread here. So you take the MACD, you take this Elder spread, you take the ribbon here. We're early in the ribbon on the crossover, and there are other things here that tell me we're okay. We may not want to buy right now. We love to buy when it's green and don't like to buy when it's yellow, and certainly when it's not red. But nevertheless, we've got room to move with dividend stocks that are in the long category. So let's take a look at a little more aggressive. If you believe that no dividend stocks are more aggressive than dividend stocks, you end up with this type of presentation. And let me go back and forth here just to make sure that I didn't blow this when let's say, boom. Okay, yeah, they are different. I didn't see the screen jump when I added this. Okay, so you can see even the more aggressive stocks are still showing upward, although we do have a little bit of rollover here starting to occur. Day over day, we're starting to come down. And you can see also here on price of the index, we're starting to come down. So these are the stocks, just relating this to something that you guys can look at. These are the stocks, the Greenfield no dividend stocks, and so that's this basket of stocks that are located in here. And so I think the key here, the key takeaway here is that the markets are still doing well, but I think we have to be careful. I think dividend stocks are the leader stocks are certainly rolling over, right? So that's what this is. The leaders are stocks that, and I'll show you this in a second, are stocks that have been doing well and are firing on all cylinders. They're making new 52-week highs, etc. So I think the key that we want to see is that although they are starting to roll over, we're starting to see the dividend stocks and the non-dividend stocks still perform well. And from a conservative basis, I think this this bull leg has some room to continue to go. When we take a look at, in fact, let me do this. Let me bring over, boom, and bring over, where is this? Let me grab my other, oh, it's on the other screen, that's why. So when we talk about Greenfield, and we're really talking about, this is a list of stocks, let me just get rid of these. This is a list of stocks that are outperforming really everything. These are the leaders that you saw right here. And so what the key here that I want you to take away from this is when we take the leaders index, and we take all the stocks that make up the leaders index, and we combine them together, we get this type of price behavior. So this says that had you bought this basket of stocks, this is what your relative performance would be. And so if you would have bought back in this time frame when it's right around 288 on the relative index, and now we're up at 333, you can see that we've moved roughly 40 points, which is what, 12-15%. I mean, there's ways to look at this. I mean, for instance, we can just do somehow. We're right around 15, yeah, 15% overall change over that period of time. So that's a great, yes, I want to clear. That's a great movement for the leaders. But as I said, the leaders are starting to show some weakness. So when I talk about what are leaders, this is the Greenfield methodology. There's a PDF that's in the Dropbox file. Many of you have it. And what it shows is that it shows that the closing price is above the 50-day, that the revenue change on a year-over-year basis is positive, that the revenues of the existing quarter are higher than 1 year ago quarter, and on a trailing 12 months that we're actually seeing at least some positive change. This should be familiar. This is kind of what you've got in the Excel file. On the EPS side, it's the exact same thing. Year over year, EPS of this quarter versus 1 year ago quarter. Again, we want to see growth there, or at least something greater than minus 0.5, right? Because of the way it rounds up. So we at least have got the same number that we had a year ago on a quarter-over-quarter basis. And then the trailing 12 months. And these may or may not be paying a dividend. If they've got a yellow in here, chances are there's no reported dividend for those given stocks. And then I also have the ability to score these. I score these in a way I look at, for instance, CSCD. That's an interesting stock. It's near some highs here. That's really, I think, very, very interesting. You can see that it gapped up back on, what was that, 2.4. Has been doing very, very well. But look at this. The volatility has been dropping off, and I think that's very, very, very interesting. So what I'm looking at here for this is stocks that have lower volatility, that are performing very, very well relative to their 52-week high, and then the 50 is above the 150-day moving average, the 150 is above the 200-day, and that we have a positive slope to the 200-day, which is this brown one here, tells me that this is something to that I should be looking at. And then I do this for each of the stocks. And so here's John Bean, and you can see it just made a new 52-week high on Friday. Volatility bumped up, and then HPY here. Again, you can see a lot of these stocks, they're decreasing volatility, they're walking very, very close to their 52-week highs, and I think that's usually a good thing. Incidentally, effective volume for HPY shows us that it's being accumulated, so I may take a look at that and see where we go from there. Another thing I look at very closely as I watch the earnings dates, and we can see that a lot of these don't have earnings at all now until April, which I think is great. That'll be very, very good for us to be able to track. So the bottom line with all of this is that you can take these stocks, you can apply them to your favorite charting package. You can get group behaviors. That's what I do with HGSI. It helps give me some insights, and then from that you can move forward with with some of your own decisions about what you're doing. Stocks that I'm invested in, I run a couple different portfolios at Collective 2. Here's the link for those. I changed strategies starting this year, so some of the performance numbers before 2015 are they took a hit with the downtrends that we saw in October, November, December. But since I had already paid my subscription fees, I just kept those portfolios going. So you'll see some relatively poor numbers prior to 2016, and just be aware that that's part of the genesis that you're going to see in there. What's a key here is that I've got a dividend portfolio. I've got that one of the accelerating portfolios that I talked about. And then I have a value portfolio that I haven't really spoken much about today. Also running some long-term portfolios over at a place called Marketocracy. These are free. You can just watch these. These are long-term holding portfolios, whereas these are subscription-based. So if you're going to get notifications and emails and do things, these would be the ones that you'd want to take a look at. Marketocracy, you're not going to be able to really act upon because you don't get any notifications that I've made changes. I do it more just from an independent verification. One of my accounts I'm tracking here, it's the accelerating sales, and you can see that overall the performance of the stocks are doing pretty well. I've got a few positions that are underwater, but in general that accelerating portfolio, which is kind of a parallel here of this collective 2, is being run. And I go from there. And then also I'm at InvestFeed, and I keep track of some of the stocks that I've posted there. Recommendations over here in red. The minute we get some red that appears here, meaning that the stock has collapsed in terms of price and or volume, some guidance recommendations of what I'll do. Sell on a new cash. This portfolio here sells on the GGT signal, so if any of these turns red, then we'll get a sell. These over here actually I hold, so even though you see a cash here, I'm only going to sell if the underlying fundamentals turn bad. So if these numbers start turning pink, it goes into a probation status, and then of course I'll look and see how far up. I don't want to let it get too far underwater, but this gives me some staying power. This methodology of selling only when the fundamentals change is a slightly different way of looking at things. Value is the same thing. If I get a change in overall values here, then I'll go ahead and sell on a GGT new cash. So it's kind of a blend of this fundamentals process as well as this. So I need a couple different gates to sell out of the value portfolio. As far as my personal accelerating sales, the 790 account, this particular one is if I get a major change here and then it's triggered by a cash setting here, then I'll get out of it. If I get just a pure cash transfer over here, a recommendation over here, but the fundamentals are good, I'll most likely hang on to it unless you see the red here. It'll be situational, and those of you who subscribe to the collective 2 accounts know that I usually put rationale out when you get your email blast for changing a position. So that's all I got for the day. The key takeaways, I think, from all of this, it's been a fairly long day, I understand, are that we've got all the timers indicating a long status, which means start moving towards being fully invested. That is mitigated by this very high level that we have in the 8-day EMA. I think that's something we need to look at, and the real extension that we're seeing here in the ribbon. I think the key here, the key takeaway as you look at the LCR table that I post, is that we still have a sea of green over here. Although we have been getting some weakness creeping in, these actually could present themselves as buying opportunities, especially with the green over here. So I think we're in good shape overall. One chart that I didn't talk about today that I will briefly is the cumulative tick chart. The CT is something, as many of you know, that I use just to look at the overall general markets. And the fact that the moving average of the CT is positive and pointing up is great. The fact that we're starting almost every day on a buying spree. This is algorithmic buying, so every time you see a move upward of this, it means you've got over 500 stocks transacting per minute on a buying, and so that's pretty amazing when you consider how does that actually occur. So this is a view into the algorithmic trading world. And then these are 52-week new highs, 52-week new lows, and this is the yellow is the net between them. And you can see consistently where the green is above the red, which if you've been following my blogs for any period of time, you can see it wasn't too long ago. In fact, here we are. We can see we went through our transition period right around 216. So back here on 2.9, we had red above green, and we had it fairly consistently. So we've gone a long way, and this is one heck of a market. You can see the transitions now from red above, red above, red above to very soon being green above. And take a look at what the CT ribbon is doing. We get that flip over here, and then it's been off to the races. And sure enough, it was confirmed. You know, we're starting to get more and more 52-week new highs. And right here's another one, and that was on 225. And then I think as we just started off, we've just got a ton of these 52-week new highs. So stocks are being bought by institutions. It's driving the prices upward. This is on the New York Stock Exchange, and this paints a very, very good picture. So as always, if you've got questions, comments, feel free to email me at pduncan@vt.edu. It's also on my blog, which many of you subscribe to. So I thank everyone. If you've made it this far through this, it's 54 minutes in. I appreciate your time, and we'll communicate more next week. Take care.